I'm at the bank making money, making moves. Machines with tools and drills, making grooves. Missions impossible.
What is up, everyone? Welcome back to In the Green with Invstr. I am Charlie Seidels, and I sat down with Invstr Intern Robbie Barletti to discuss an article he wrote about some of the ways new investors can analyze stocks. Here is our conversation. How you doing today, Robbie?
Pretty good. How about you?
I'm really good. So could you break down what the three methods a new investor can use to look at stocks are?
Yeah, so just high-level overview goes from most simple to most advanced. So first method I go into basically is looking at momentum and news. Describe that a little more later. Next, we're looking at technical indicators. And then the last section, we're going to be going over some financial ratios and looking at how the different companies compare to one another. So, to break these down, step by step. First one we're looking at obviously is news. If you want to learn about a company, you can read the news. That's always something pretty helpful. Then the next thing that I find pretty helpful to look at is momentum. So this kind of means looking at the different time periods and how the company's been trading. So for example, you can look at the daily chart on Invstr. You can see, is it going up or down? Trends tend to continue unless something happens. So it's going up in a day, might continue. And it's good to look daily, weekly, monthly, even yearly. That can be pretty helpful.
So what are some of the positives to using momentum, and what are some of the drawbacks to using momentum in news as a way to trade?
Yeah, so I think the most obvious positive is it's something really quick, and it's something literally anybody can do. You can look at stock for a few minutes and decide whether you want to trade it on Invstr really, really quickly with this strategy. You could have a great portfolio, and you could have a lot of different companies you're looking at, and that's really exciting and a really great way to get started. The downside is you're missing a lot of information that some more sophisticated investors might get. For example, earnings, some big changes in the company, that kind of thing might be missed there, and it could hurt you. But on average, I have seen this work with a lot of newer investors, and that's why I'm recommending it.
So what are some situations where using momentum will fail as a strategy?
Yeah, so I think the most obvious way that it's failed is, with earnings. This has happened to me a few times. Every quarter, so 4 times a year, a company will release earnings and basically say how they did in the quarter. And if you're not paying attention to when these earnings releases come out, you might be caught off guard. For example, this happened to me with a few stocks like Pinterest. Had great momentum, news is looking good. I thought it was really undervalued, and it just went down because they had a really bad quarter, and I had no idea, so lost out on that one. So that's a pretty good example of how it can go pretty poorly.
Okay, that makes a lot of sense. So moving on to, I think you said the next thing was technical indicators. What are technical indicators?
So very basically, technical indicators are methods of looking at price, and that's the only thing they look at. They're just looking at price. So again, this does miss out on a lot of information, but it also can capture some things that looking at just the graph might not. There are a bunch of technical indicators, but the ones that I prefer are the RSI, the MACD, and Bollinger Bands. So just to break them down a little bit, the RSI is basically a graph, and the graph reads 0 to 100. If it's at 30 or below, it indicates that it's oversold, or basically undervalued there, historically relative to the price.
When I see a RSI of below 30, that means it's oversold and that I should be thinking to buy, just if I'm looking at the technical indicator.
Exactly, yeah. Just by looking at the RSI, if it's under 30, it's telling you to buy.
Okay.
And similarly, if it's above 70, it's telling you, it's overbought, so maybe you should sell there. Now, the issue with this is, again, it's only looking at the price, and it's looking at it in a really specific way. So it's a lot of the signals they can be not right, but it can give you a good, feel for where the company's at and how it's doing. Definitely not to be used alone.
Again, my question is, where does this fail? Why does just looking at the price not give you the full picture?
Yeah, so this can fail in a few ways. I think the most obvious way is if the outlook on a company changes. So, looking at Tesla, a bunch of great earnings, and that causes, people to want to buy Tesla and be very bullish on the prospect of Tesla. And what this means is the RSI has been above 70 for a long time. And, this means it's telling you to sell or to short. And, that's just not the smartest thing to do right now. I know a bunch of people have done pretty poorly with the strategy.
Okay, gotcha. But so it works better in situations, say, where there haven't been huge changes to either the market or a company for a period of time.
Exactly. It's a perfect description of when you should use it.
Okay, got it. And the indicators that you like are the RSI, the MACD, and what's the third one?
Bollinger Bands.
Bollinger Bands. And can anyone just find these online?
Exactly. Yeah, they're available on Invstr. Invstr has the charting feature where you can see, the RSI, the MACD, and the Bollinger Bands, and they're very useful tools. And I personally use them a lot.
Okay, perfect. Very cool, very convenient to use. And then what was the third method you used?
Yeah. So the third method is definitely the most complicated here, and it's probably not something I'd recommend starting off with, but it's something that I personally use, and it's a really, really powerful tool that can incorporate a lot of different data points. So it's called comparable analysis. It goes by a few different names, but basically it's using financial ratios. So just to take a step back, what this is doing here is it's looking at financial statements. So like I mentioned, companies report quarterly earnings, and they basically tell you how they're doing, how much money they earn, how much money they actually take home in cash. And with this information, we can basically create ratios. What ratios allow us to do is to compare different sized companies. It might be hard to look at a really large company and a really small company because one might earn a lot more than the other, and I think it might be hard to compare. A way to do that would be basically looking at a profit margin. Profit margins are similar across all different types of companies, and that's a really easy way to compare. So again, I would definitely not recommend this for beginners, but this is a really, really powerful tool.
So there are a number of different ratios you highlight in the article. What are these and which ones are the best to use? Or are they different ones that are good to use in certain situations?
Yeah, so first, I guess we'll have to define some terms. Let's define enterprise value. So enterprise value is basically the entire value of all the claims on a company. Basically, simply, it's the amount of debt of a company plus the equity value. Then we went to EBITDA. EBITDA's earnings before interest, taxes, depreciation, amortization. Simply, we can just call this earnings. No need to go in depth there. Then we have cash flow. So literally looking at how much cash the company is getting. And these are the ratios of the company that we're going to talk about. So we have enterprise value over earnings. This is basically saying how many times the company's earnings is the enterprise value equal to. And this is a way to compare how overvalued or undervalued a company is. The way I like to think about it is if a company's value is less times the earnings, then that company is more undervalued than another. Another ratio that I think is really powerful is price to earnings. You've probably heard about it. Basically, price divided by the amount of earnings of a company. That one's telling you basically how much you're paying for $1 of earnings. That might be a little bit weird, but if you think about it like this, you'd rather pay more for $1 of a company's earnings if you expect the earnings to increase at a faster rate. So again, that one is a really useful one to measure, again, how overvalued a company is. The last, I guess, valuation ratio we have is price over cash flow. And this is exactly the same as price to earnings. The only thing is that earnings can have some non-cash expenses and a little bit of fancy accounting going on there. So cash flow is basically just literally how much cash is a company getting. So that one's quite a little more simple than earnings. And finally, we just have earnings margin. So basically, how profitable is the company? And that's used to basically justify some valuations. You're obviously willing to pay more for a company that's more profitable. And that's just a good way to summarize that.
So one thing you said about this method that struck me as pretty cool is the fact that you can use this across different companies that are different sizes. So let's say a company is like 8 times bigger or 4 times bigger or whatever. You can still use these ratios effectively. But a question that I have is, how well do these ratios hold up, say, across different sectors?
Yeah, so that's a great question. So again, you can compare companies that are in different sectors with these ratios, but I personally would not make investment decisions based on that. I think the most powerful way to use this method is to find companies in a similar industry, and ideally the more similar the better.
You said that each of these 3 methods has its positives and negatives. What would you say is the biggest negative to using this third method, or are there fewer negatives because it goes more in depth?
Yeah, so I think you definitely got it right there. I think there are fewer negatives in this method, but again, as always, there are a few. I think one of them is that it's what we call backward looking. So it's using basically historical data. So if a company, reported their results on January 1st and we're using it now, it's a little bit lagged behind and not really looking at, the future outlook of the company. You can project what the company might do in the future, but again, it's a little bit speculative. You're not necessarily sure of it. So there's a little bit of weakness there. And then finally, like I mentioned, companies, give guidance on how they're going to do, and you can base a decision on that. But, sometimes they either, beat the guidance or they miss the guidance. And again, that can cause these ratios to be wrong and end up in a poor investment. But, overall, I do think this is the strongest method because it's taking into account, financials. If you do it over multiple years, you can take into account momentum as well. So I definitely think that this is one of the best methods overall.
Gotcha. And where would I find these numbers online?
Yeah, so I go into pretty depth on the article. Basically, there are a few websites that I like to use. There's macro trends, Y charts. Also the Securities and Exchange Commission has a website where you can look up every company and you can see their financials. So all these methods are ways to get the financial data, but the ratios that I listed are actually quite common. So if you just put them into Google with the company's name, you'll find them quite easily.
That's great. Now that we've covered all 3 of the different methods that you wrote about, what are your final thoughts on how new investors can mesh them all together when investing?
Yeah, so I think if you're a new investor and you're really interested in this, I think the Investor Academy is just a really great resource. I like to think of myself as a little more experienced, and I took it and I still found it very useful. After taking that, I'd recommend going through the list of these methods. I think starting with news and momentum, I think that's a great way to start. And as long as you can keep learning, improving, I just think that's a really great thing. And eventually it works. We see a lot of people come on Investor not really knowing much, but with the community and asking questions, I think they can really learn. And now, some of them are doing really great.
Any final thoughts or words of advice to new investors?
Yeah, I'd say, just read as much news as you can, just keep learning and, ask questions. People are always happy to answer them. I know, tag me, I'll definitely answer any questions. So yeah, just reach out.
Awesome. Thanks for coming on the podcast today, Robbie.
Thanks for having me.
Making money, making moves, machines with tools and drills, making grooves, missions impossible.
I am not a financial advisor, and my comment should never be taken as financial advice. Investments come with risk, so always do your research and analysis beforehand.